Right, well, lots happening now in the market, so let's get our market master into the conversation as well. But before that, it's time for the CNBC TV18 budget quiz. Just a day to go. Remember, there are prizes to be won every day. Without wasting any time, here's today's question. What was the fiscal deficit to GDP for FY22 revised to in the last budget? Your options are A, 6.6%, B, 6.7%, C, 6.8%, and D, 6.9%. If you think you know the answer or you want to just take a guess, post your answer in a comment on the question tweet on @CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Hurry and send us your answers. Remember, we'll announce the winner at 3 p.m. today. In fact, we have Dhiraj Agarwal, Co-Head-Equities at Ambit Capital, who's joining us now. Dhiraj, good morning and thanks for joining in. So the expectation this time, and just taking from the CNBC TV18 budget quiz, right? The expectation is that the fiscal deficit could narrow to less than 6% of GDP. And on the back of that, the government could perhaps ensure that public capex spending is sustained. The focus could be on growth this time. Is that your base case assumption as well? And anything else that could drive the markets higher from the budget per se?
I think that expectation is quite reasonable. We are also expecting fiscal deficit to be lower and to be contained. And the central government push on the capex and infrastructure to continue. Whether that's enough to drive the market higher is another question at this point of time. Our preference is at this point, a huge rally, despite whatever the budget does or tries to do, is going to be a bit difficult. So still looking at a little bit of a range-bound market scenario with a slight upward bias, but not a completely breakaway market.
Okay, so then from a sectoral standpoint, is there anything that you would go with? I mean, into the budget, anything that you like this time around? The focus will be on capex, manufacturing, defense, renewable energy. So a lot of these companies, I mean, of course, a lot of the announcements have happened off budget through the course of the year. But particularly from this event, any stock-specific or sector-specific biases that you'd have?
Not at all. I think barring the one-day volatility, 1.5-day volatility around the budget has stopped actually moving sectors and stock prices in any meaningful fashion quite a few years ago. But for one reason or the other, the market seems to be still obsessed about budget being a turning point. Budget is what it should be. It's an accounting exercise of the government revenues and expenses. And a little bit of shift, a little bit of tilt towards capex, revex, fiscal deficit, etc., which drives a little bit of macro. Most of the policy announcements and the big policy shifts are now outside the budget, which is the way it should be. So no, I have no budget recommendations, positive or negative at all.
All right. Hi, Dhiraj. Good morning. You've told us your preference in terms of the banking names, SBI as well as ICICI Bank. Both of them, after seeing a good rally, and they were the flag bearers really of that nifty bank up move. But they've come in for some profit taking. From the banking space, would these two find preference yet again?
Yeah, we like Axis as well. So all three. And so all three should find preference at this point. But we've been saying also for a while that banking should see some margin pressure going forward because credit growth has been running like mid-teens, 15, 16, 17%, but deposit growth only 8 to 10%. And the surplus liquidity which the banking system had been almost completely utilized. So at this point, there is no option but to chase deposits a little bit. Which will result in some impact on the margins. I don't think market is fully pricing in that. So while within the space, we like these three names as our top three picks. But beware that, a bit of margin pressure going forward in the next few quarters, 3 to 4 quarters is bound to happen.
Dhiraj, do you have a sort of conviction market view in the near term? Which way are we headed? Are we at a bit of a impasse, or you think things will move quickly?
No, I think it's still a range-bound market. So our theoretical EY/BY model has a estimate of 19,600 by end of this year. But at the same time, we also observe there are lots of fault lines appearing in the market this year. And if at all we do reach a fair value, it's going to be a rocky path with lots of choppy up and down movements. or it's quite possible that we may actually miss it as well, although that's a theoretical fair value basis EY/BY model, because a number of fault lines are appearing. So my preferred market bias at this point of time is we continue to chop in a broadly 10% range, 10-12% range, without going anywhere this year as well. So quite similar to what we saw last year. We chopped up and down 2 or 3 times, ending the year with just 4% gain. I'll be surprised. I'll be surprised if I see more than a 4 or 5% net move in the market on either side come December.
In fact, now the market is, taking a cue from what you just said, right? And it's getting into extremely choppy terrain. The Nifty is now down almost about 30 odd points. The sensex has lost its mojo, early morning mojo, and is down about 120 points. Pressure coming into some of the vulnerable names in the broader markets. Yes Bank, Zomato, all under pressure right now. Nykaa is down 1.5%. And from the Adani group, it's disparate moves. So Adani Green is now down almost about 8 odd %. Dhiraj, just one follow-up to the whole view on banking. I understand, I mean, you were saying, you were talking about the impact that chasing deposits would have on margins, etc. But what was the sum and substance of what you said? Would you look to buy any of the large cap banks now? Because it's a steep fall, right? SBI, for example, is down 15% in Jan already. Good time to buy?
Yeah, I think so. I think, the banking stocks might have fallen for a different reason at this point, but at least after this fall, hopefully this little bit of NIM pressure with that we'll see may not really impact the stock prices too much of the downside. So they are certainly buy the dips, but the kind of returns that we saw in banking space last year, don't expect that to be repeated this year. So, one of the key takeaways, or one of the key deciding factors of a choppy market is that the price of entry or price of purchase becomes very, very crucial, which was not the case, let's say, a few years ago, when sectors and stocks which were doing well kept on doing well, and irrespective of price of entry, you still made money. And now one has to be a little sensitive about price of entry. So yes, you're right, these dips might be buying opportunity in banking names.
Okay, all right. Dhiraj, the sector that's done very, very well in this year so far is the IT index. And I recall you being quite constructive on select IT names. Do you maintain that view? And if you could give us, in terms of preference, if you could name a few stocks.
Yeah, we maintain that view. In fact, we are carrying a strategy called that IT should outperform the market and even perhaps banking for a while. And the reason for that is, what I prefer to say, is more by elimination rather than selection. So expecting to see, as I said, we're expecting to see margin pressure in banking. We are seeing some amount of demand slowdown in consumers. Pharma is still sort of struggling. So IT becomes the place by elimination to park some money, and IT had underperformed quite sharply last year, falling 30-35%. Last 2 quarters, we haven't seen any earnings cuts in IT, although we do expect fundamentally that next year growth will be soft, but relatively speaking, it's standing out a little bit. So we like within the space, HCL Tech is a top buy. Tactically, we like TechM. Mid caps, we like Emphasis. Amongst large caps, while we're carrying sell recommendations on both TCS and Infosys, at the current valuation, we prefer Infosys over TCS. So that's the broad sum and summary of our IT view.
Okay, thanks a lot, Dhiraj, for joining in. Have a great day. Thanks for being with us on the channel. That's Ambit Capital with their view. By the way, don't lose focus of what's happening in the market. There is definitely selling pressure. Budget or no budget, this market